You founded Zimmer in 2007. That became Lyft in 2012. You're here beating your biggest rival to going public. How does that feel, Logan?
Feels pretty amazing, and there's nothing better than we have all of our earliest investors and the team that's been with us, a lot of them since we started in 2007. Just feels incredible.
You're here at the new Lyft Driver Center in LA. You're not on the floor of the Nasdaq. Why was it important, John, to do it this way?
Well, we want to make a point that you can both invest in communities and build a great business. And our driver community has enabled us to be here at this point. So it's fun to ring the bell with several members of our driver community, have many of them participate in the IPO because we gave them a bonus to do so. This is just the start of how we partner with cities and the people we serve.
And you're giving drivers stock bonuses, right? That's kind of unusual.
Yeah, we're giving a cash bonus and the ability to participate through their friends and family program.
So let's talk about costs. There's a lot of question, how can you bring costs down? You brought in $2.2 billion in revenue last year, but you also lost some $900 million. How quickly can you bring those costs down, John?
Well, I think it's important to have the context that what we're going after is a $1 trillion market opportunity. Every year in the US, Americans spend $9,000 owning and operating their car and using it only 5% of the time. And so this massive market shift, just like entertainment has gone streaming, is happening with car ownership. And we're investing to take advantage of that. Our economics are improving, and we're very confident in the path ahead.
So, Logan, in your risk factors, you say you may never be profitable. I mean, how do you convince investors that they should be betting on the optimistic here?
If you dig in on the numbers, every year the economics of the business improve, and we are confident that the business will be very profitable. There are, of course, risk factors, but we are making tremendous progress going after this once in a generation shift where this entire industry, potentially, a $1.2 trillion market, could flip from an ownership model to a service model, and we're leading the way there.
So could you be profitable in 5 years?
We can't talk on forward projections, but as we said, we're very confident in the long-term profitability of the model.
Now, in the weeks leading up to this, I've noticed I'm a Lyft customer, I'm an Uber customer, steep discounts. How is that sustainable, and how does that factor into your customer acquisition costs in the future?
One thing to know is that there's actually been rapidly decreasing numbers of discounts in the market. The times that they are used, we're really managing the balance of our own market. So something a lot of folks don't think about, but every year Americans make New Year's resolutions. They come back, make a resolution to lose weight and save money. And that means they go out less. But it's amazing what a 10% off coupon can do. It can break a New Year's resolution very quickly. And we do that because we have a lot of drivers on the road. Last year, 1.9 million drivers drove for Lyft. So we have a lot of drivers on the road, and when they're not busy, that's bad for business. So we'll give out targeted coupons as a way to take care of drivers and make sure that their business stays busy. But it's a very rational market, and that's really the reason of driving it.
So you're speaking to something, you're making choices behind the scenes. You are prioritizing at times market share over margins or margins over market share. So
that's not the right characterization. This is really about the most effective way to drive growth and profit in the business is by running a balanced marketplace. So the coupons and managing seasonality are really about keeping a very healthy, vibrant marketplace and keeping drivers engaged because, the next week, after a slow week, the next week you have, say, St. Patrick's Day, and it's roaring and we couldn't possibly get as many drivers as we need on the road. So it's an important engagement.
So John, let me put it this way. If you focus on margins one day, does that give Uber an opportunity to claw back market share another day?
We're not focused on our competition, we're focused on what we control. And so every day we're thinking about how to serve our drivers and passengers, build a long-term model, pushing down our operating costs and, like this driver center, the operating costs of our drivers. And that's what's allowed us to go from just over 20% market share 2 years ago to nearly 40% market share. We don't focus on market share. We just execute and serve our constituents.
You did grow market share considerably over the last couple of years. 22 to some 39%. At the same time, Uber, I know you don't focus too much on the competition, as you say, going through sexual harassment allegations, a delete Uber campaign. How much do you think Uber's mistakes helped you? And then conversely, if Uber stops making mistakes, does that hurt you, Logan?
I think what we saw in 2016 was something really unique happen, and we hit scale in most of our major markets. So in this business, if you're operating subscale, your pickup times are too high. But when you hit scale and you can reliably deliver a 3-minute pickup time on average, that's a huge unlock. That's what it takes to compete. So before 2016, we didn't have scale. In 2016, we hit scale. And that's when we started competing on execution and delivering a better experience. And we were taking share well before any of the competition's missteps. And that's continued and accelerated since.
Drill down into this market share number for me. How much does that fluctuate? Is that based on total spend? Where does that number come from?
The number used in the prospectus was based on rides. And it changes every day and every month, but the trend has been very good for Lyft.
So is getting to 50% market share in the US more important than expanding internationally, Logan?
Our focus is always on taking care of our customer. So we don't set market share goals. We focus on delivering the world's best transportation to our customers. And so we do think about international. Every year we sit down and we make the trade-off. Can we go deeper on this $1.2 trillion market in the US and deliver better transportation to our customers here? Or is it time to go abroad? And so a little over a year ago, we launched Canada, and that's been a great experience for us. And we'll continue to consider international opportunities. I think it's sort of a great call option, but right now...
What do you mean by a great call option?
You know, I think it's a great... There are many future growth opportunities in this business, whether we're going deeper in North America or going international. So we look at that as a call option for the business, and we may choose to do that someday, but we don't have current plans right now.
If you were to launch in an international market, a new one outside of Canada, John, what are some exciting markets? I mean, what are some markets that you've looked at?
We believe there needs to be, at least 2 players in a given market, and so we would look to markets where there's just one, and that would be the best opportunity should we decide to go international, except for China.
Okay.
Yeah.
Let's talk about founder control. You have a lot of voting power, almost 50% voting power, but you hold 5% of shares, and there was a lot of backlash when this came out. What's your argument that that's the best way to govern this company?
Yeah, we put a lot of thought into this with our board and a lot of our investors, and we really wanted to set the company up to go after the long term and make the right investments to seize this long-term opportunity. We think that's going to be necessary to deliver the largest shareholder returns over time. And so dual class was an important piece of it. We designed it, John and I together still have less than majority control. We selected an independent chair. Sean Argawal has stepped in as the independent chair of the Lyft board. And we have, I think, an incredible board from a diverse set of backgrounds set up to guide the company, and we think collectively that's the right package.
But there are concerns, John, that this won't lead to the appropriate checks and balances you need on a public company. And we've seen situations at Google and Facebook where founder-led decisions were made that maybe weren't the best decisions. How do you respond to that?
I would respond by saying we've been balanced in how we've put this together. As Logan mentioned, we have an independent chair, we have a diverse board, we have a great broad set of shareholders, and when we talk to our investors, we let them know that we care deeply about their views, care deeply about incorporating them, and our track record shows that.
You've been investing heavily in self-driving technology. How much and how fast do you think self-driving technology will bring your costs down?
I think we're still years away from self-driving.
How many years?
I wish I knew myself. I don't, but I think there's kind of a conception that there's going to be a magical self-driving vehicle that'll appear one day and do every ride. But the way we see it playing out from all of our work in the space is that the first generation of vehicles will only be able to do a subset of the rides. So I think it'll be critical that they're rolled out on a platform like ours, where you can count on drivers to fulfill every request, right? It may be a long time for security reasons before an empty autonomous vehicle is allowed to do a pickup at an airport, let alone drive in extreme weather, drive at night, drive at certain speeds, through bridges and tunnels. There's all sorts of restrictions that the first generation of vehicles will have. So I think we're a number of years out from the first generation, and that may be able to do, say, 10% of rides. And then the second generation could do 30% of rides. I think you'll see, it'll be quite some time, probably a decade or two, before you have a car that can do every single ride out there. So I think a network application for deploying self-driving cars will be the majority case for the years to come.
Then in the meantime, John, I know you're very focused on changing trends in car ownership, but in many cities where Lyft and Uber are big operators, you're actually seeing an increase in cars on the road. You're seeing more concession. You're actually seeing more car ownership. What evidence have you seen that car ownership trends are actually changing?
Well, I think actually we've seen like peak car ownership, and if you look at the national numbers, you look at people that are purchasing or deciding not to purchase. If you look at millennials that are coming of age and waiting or not getting their license, and if you look at our growth, I think there's a pretty obvious trend. Last year, over 300,000 Lyft customers got rid of a car. And so some families are going from 2-car to 1-car, but it has begun.
In your roadshow, you really talked about how you don't do food delivery, you don't do trucking. Lyft is about focus. That said, you are getting into new businesses, scooters, for example. What is going to be your biggest source of new revenue in the future? Will it be scooters, Logan? Will it be international expansion? Will it be something we don't know about?
We compete with car ownership. So when you open up the Lyft app, we want to provide you every possible option that you could be trading off, whether that's public transit or connecting you with a Lyft to public transit, whether it's a bike or a scooter, a shared ride, a regular Lyft, a luxury ride. We want to provide you with any possible option. So we see competing with the car that's parked in your driveway as the primary goal.
And speaking about the future of drivers, I know self-driving technology is very important. It is long-term, as you say, but so much of Lyft has been about the values, treating customers well, treating drivers well. If you're investing in self-driving technology, doesn't that mean all of those jobs go away? And doesn't that sort of undermine those?
No, I don't think those jobs go away at all. In fact, we're going to need many more drivers over the next several years. Think about today, the entire ride-sharing market in the US does just 1% of miles traveled. As that goes to 10% of miles traveled, you would need either 10 times the number of drivers. If we're at 2 million, nearly 2 million drivers now, we're talking 20 million drivers. Obviously, there's room for both increasing the number of work opportunities and adding autonomous vehicles.
So where's Lyft in 5 years?
In 5 years?
In 5 years.
In 5 years, we want you to be subscribing to a package of miles. So similar to the way you have a cell phone and you subscribe to a number of minutes, we want people to completely get rid of their car and jump into the world of transportation as a service and subscribe to miles so that you don't have to think about each trip. You're just fully on board in the Lyft ecosystem. So
something like Lyft Prime, is this like a monthly thing, a yearly thing?
It'll still have to take shape, but I think people will be subscribing to miles.